What's up everybody, this is Joe and welcome to Smart Couples Finish Rich, step number 7, the review. If you have not checked out steps 1 through 6 yet, I'll put a link up there and down below. Please subscribe and like this video and share it with friends that you think can use these tips. As always, if you have not gotten the book yet, please do so. Smart Couples Finish Rich by David Bach. He goes into a lot of details that I don't go through here. I only give you a high level review. I have to put the disclaimer out there that this is not financial advice. I'm not a financial advisor, just someone on YouTube reviewing a book. Okay couples, we are on step number 7. Building your dream basket. We're almost to the finish line. Let's go. In order to build a dream basket, you have to have dreams. So let's write down some dreams together. Pretend you're a child again and that you can do anything and be anyone. What would you do? Who would you become? Fun fact, when I was a young kid, I wanted to become a Hong Kong pop star. I never pursued that dream here in the States because there wasn't too many role models to look up to. I would have had to move back to Hong Kong. I don't think my parents would have wanted to go back there when they migrated here. If there are any directors and actors out there that want to hire somebody, right there. Also, what do you and your partner want to do together? Dream up as many as you want. However, write down your top 5. You want to do this individually first, so dreams just for yourself. And then afterwards, you work on the dreams together as a couple. Number 1, list your top 5 dreams out. Remember, have fun with this. Be kid-like, not adult-minded. Number 2, make these dreams specific and as measurable as possible. Number 3, take action steps within the next 48 hours to get the ball rolling. Doesn't mean you need to acquire these dreams in 48 hours. Take small action steps towards it, like getting a brochure or Googling it. Number 4, share your dream with somebody. This is very important because if you share it with somebody, you're more likely to act upon it. We don't like to let ourselves down, but what's funny is that we don't like to let other people down. If you share it with someone, you're more likely to get it done. Number 5, remember the value circle. Which value would this dream help you to realize? Number 6, what would a dream cost? A lot of dreams don't cost you anything. However, a lot of people stop going for the dreams because there's a big money roadblock. We want to know this cost so we can attack that roadblock. If you don't know exact number, just write down the estimate. The author here gives us a worksheet to write these dreams out and put an action plan to it. As always, I'm going to disclose what Nita does with these exercises. So here are her 5 dreams. Number 1 is to swim in an ocean and to go scuba diving. She is deathly afraid of swimming. I'll try to put up a video of her swimming here. And with me as a teacher, she'll be going to the Olympics in no time. Number 2, she wants to learn Chinese. She asked me to teach her, but my Chinese is at a 3rd grade level, so we're going to be learning together. She also wants to learn ASL, American Sign Language. She has taught me 2 signs so far. Thank you and please. I'll be utilizing these signs during dinner time. Number 3, she wants to play an instrument. Shameless plug here, but our future brother-in-law is a musical genius. I'll put some of his links down there and a short clip of him up there. Patty, if you're watching this, ask Kurt if we can learn piano or guitar from him. Make sure to follow his channel. He doesn't have enough followers, only 12 million. Number 4, she wants a vacation home that faces the mountain and the lake. First time I've heard of this dream, but I ain't mad at it. I would love a vacation home where it's serene and relaxing and I could just chill. And number 5, she wants a convertible car. Honey, I will help you get a convertible toy car. Don't you worry about it. Let's take a convertible car as an example and apply it to this worksheet. She has to write down the specifics and the measurables about it. What color, what make, what model, and also what the deadline is. Within 48 hours, she has to pick up a brochure, design a car online, do something. She has to share the dream with someone and she already shared that with me. She also has to ask what value does it help her to accomplish by having this dream. I don't think this dream fits into her value circle, so this convertible car would have to be wiped out. And lastly, what will the dream cost? I think a toy convertible car is about 50 bucks, so I got you, honey. Now that we have your dreams, how do we start investing for it? Here you want to apply the systematic investing strategy. What that means is that you want to auto invest. This way, you can take the excuses out, like, oh, I didn't put cash into the bank, I didn't write a check. Auto investing will automatically take it out of your paycheck and put it into an investment vehicle. You can also micro invest nowadays. Instead of buying a stock for $1,000 like Amazon, in today's day and age, you can actually buy into that stock with only $5. That is called micro investing. If you're looking for a micro investment platform, I recommend SoFi. I'll put the link down below. Right now, they have a promotion that with your initial deposit, they'll give you $75 for free. On that platform, you can use that $75 to micro invest into a lot of different companies. The author suggests saving at least 3% of your after-tax income for your dreams. Of course, you can do more if you want to. He says that if you're dream challenged, meaning that you don't believe in dreams, just save 1% anyways. You might have some dreams later on. Then you can increase that 1% every 6 months until you hit the 3 or 4% mark. This whole step I agree with to a certain extent. Let me give you an example. My father immigrated over here from Asia, and he had his own dream of owning his own business. He never followed the Smart Couples Finish Rich book with my mom. What he did was he took a HELOC loan out of the home equity. Took about $100,000 to invest into his business. He was working 9 to 5 as a banker and built his business part-time. In my mind, that's also an investment. And that investment really paid off. He made probably 2 to 3 times more in his business than in his 9 to 5 job. If he followed his 3% rule, he might have never hit his dreams until 60 years old. Now, I'm not telling you go out there and swing for the fences and over leverage yourself. I'm just telling you this is not the end all be all in terms of your dreams. This is just another option for you to achieve your dreams quicker by investing for it. So where do you put your money? The author here suggests to invest into mutual funds. And what is a mutual fund? A mutual fund is an investment company that pulls the money of many investors and buys various securities like stocks and bonds. Investors who own shares of the mutual fund thus automatically achieves the benefit of a diversified portfolio without having to buy individual investment themselves. What this means is that you don't have to go buy Amazon, Google, Facebook stocks and then go buy state and government bonds. A mutual fund has that all diversified within it for a fraction of the cost. They'll also manage it for a low fee here, 0.57%. That's really low. There are 6 reasons to invest in mutual funds. I'm just going to read the bold type. Number 1, systematic investment program. This is what we talked about earlier. Auto investing makes it easy, takes away the excuses. Number 2, they offer instant diversification. Just like we talked about earlier, instantly diversify in the stocks and bonds without you picking every single one. Number 3, they offer professional money management. They will do all the buying and selling within that fund itself for you. You don't have to update it. That's why they charge you the management fee. Number 4, they're very cost efficient. As we said earlier, you can even spend $50 and be well diversified. Number 5, they're liquid. They're not locked to your old age. You can take it out immediately. However, you do have to pay taxes on gains. You also get to claim losses against your taxes though. There are certain limits to that, about $3,000 a year. You want to look into that information for yourself. Number 6, they're boring. They don't fluctuate, which is great. We want them to go up and not down. Okay, let's take a look at different investment vehicles for different types of dreams. If your dreams are more like short-term goals, 2 years or less, you can place the money into a money market account for liquidity. When you open a money market savings account or a money market checkings account, this is basically a mutual fund that invests into short-term securities. The bank takes your money, puts it in mutual funds, gives you the gains, you experience none of the losses. The gains is very little here though. I think the most I've seen is about 4% in a money market account. For your midterm dreams, 2 to 4 years, you could put them into short-term bond funds. A bond is basically an IOU from the government or the state. A bond fund is just a diversification of the bonds. The bond's an IOU, so you can ask for money back in 6 months or 4 years. This is called the maturity date. So you can buy short-term bonds in 6-month blocks, 1-year blocks, maybe 3-4-year blocks, 5-year blocks. Bonds are typically safer investments. You might hear the words junk bonds being thrown around. There's a different grading level for bonds. I'm not an expert here, so I'm not going to get into it, but you can Google that. Another investment for your midterm goal is a balanced fund. So a mutual fund that's invested into both stocks and bonds with an allocation of either 60-40 or 70-30. This is 70% stocks, 30% bonds. The reason you want to invest into these vehicles for short-term or midterm is to hedge against inflation. Inflation is typically 3%. If you're not making more than that, your money is actually losing value. So you don't want to put money into your sock drawer, a pillowcase, or a safety security box. You want to put it into the market. If you have a long-term goal for 4 to 10 years, like Nita does for a vacation home, here's where you want to invest your money. You want to invest into an index fund. This is a stock mutual fund that mimics a specific index. An example here is S&P 500. So the S&P 500 tracks the top 500 companies. There's tax advantages here because you're not really trading. You're just tracking the top 500 companies. That doesn't fluctuate way too often. There are lower management fees for indexes as well. Where a regular mutual fund will be a 0.57% management fee, an index fund could be even half of that. An index fund outperforms 75% of managed mutual funds. That is pretty crazy. Here are some examples of index funds and their tickers. These are companies from Vanguard, Fidelity, and Charles & Schwab. Another type of index fund is an exchange traded fund. The only difference here is that it's tradable during market hours. An index fund is tradable during market hours also, however, the price gets executed at the end of closing. With an exchange traded fund, you could trade during the market hour and get the pricing that it is at that hour. A little bit of difference in nuances. I guess it makes a lot of difference for some people. And there are some tickers for some exchange traded funds. All right, now if you have over 25,000, that's beyond the getting started phase. Here's what you want to consider to invest. Number 1, consider a diversified portfolio of mutual funds. If you don't want to think about all that headache, then 2, pick a target date fund. There's maturity dates of 10 years, 20 years, 30 years, pick your date. A target date fund is set it and forget it. It might start out with a 90-10 allocation, and as the dates start to get to maturity, will reallocate to a safer portfolio, maybe a 20/80 or a 30/70. The author gives us some options of funds here. Number 3, a large cap value fund. These are companies that have a 10 billion plus market cap, and they pay you quarterly dividends. Dividends are taxable up to a certain amount. I'll put a chart up here. These are considered value funds, which means that they're high yielding large cap stocks that are underpriced. Number 4 is a large cap growth fund. Just like the above, they're 10 billion plus caps. However, no dividend payouts here. Why? Because they're looking to reinvest for growth. If you're watching this in 2020, that could be a company like TikTok. They have a huge market cap, but they're probably looking to grow more. Another example is Airbnb. Huge company, over 10 billion market cap. However, they're still looking to grow more. They're not even on the stock market yet. Number 5, we're getting a little bit riskier. This is medium capitalization funds. Companies here are $2 to $10 billion in market cap. They have a lot more exposure to volatility and risk. Number 6 is small cap funds. This is companies with $250 million or $3 billion in market cap. These are ultra aggressive investments. However, potential great returns. Here you are betting on the hare versus the tortoise. You want no more than 20% of your portfolio here. Lastly, international or global funds. These funds aren't 100% international. Typically, they're 60% international and 40% domestic. If you're watching this video in 2020, it is said that by 2026, China's GDP will outgrow America's. That is why you want to diversify, is to capture some of that growth. Who knows if it's really going to happen? That's why it's called diversification. You want 10 to 20% of your portfolio here. Okay, if you're curious about the average returns of some of those funds, here it is. From 1989 to 2016, that's a 27-year time frame. We can see that the small to large caps gain anywhere from 8% to 10% a year. This is why it's important to put money into the market versus into a pillowcase. If inflation is 3%, here you are beating it and making some money for your dreams. Definitely in 2020, as you're watching this, you're thinking, oh my God, the world is melting. What about corrections? What if I lose all my money? We just experienced a 30% dip in the market. Well, the author says here, recessions makes millionaires. I didn't say that, the author did. The markets have always recovered. If you don't panic, you can live through it and thrive. This is a true statement. If you look at just the online charts, you can look at all the past dips and recessions. We have always come out of it. We are going to get through this one. Don't worry, guys. Let's take the most recent example. In 2008, there was a mortgage crisis. People were giving ninja loans. No income, no job, no assets. If you're breathing, you got a loan. Needless to say, everyone started to default on their mortgages because they couldn't afford it, because they didn't have any income, they didn't have anything to back it up. The whole world melted in 2008, everyone losing their houses, foreclosures were at an all-time high, short sales were at an all-time high. No one thought housing was going to recover or the markets would recover. People are losing their jobs like crazy. Financial institutions shut down, everyone was freaking out. Let's take a look at 1 year after that happened. From 2009 to 2017, that's 9 years. If you had steady hands and dollar cost average investing into the down market, in those 9 years, you would have averaged anywhere from a 10 to 18% return. In the book, the author says that you invested during this 9-year period, you will have experienced a 300% gain on your investment. You might think, oh, 300%, that's not a lot. That's a lot for not doing anything, and for 9 years. And right now, we're in the middle of 2020, a pandemic that has caused a market dip. What should you do now? I'm no expert, but according to history, I would buy into the fear. Okay, the author gives us a general idea of funds. Large, mid, small caps. Index mutual funds. Bond funds. But how do you know which ones to choose? Number 1, you could do it yourself and study. Take a look at the fund, look at the last 10, 20, 30 years of returns, if the fund has even lasted that long. If you're lazy, just set it and forget it, do a target date fund. Number 2, you can hire a financial advisor to manage it for you. Here, you just have to live with the management fees. Or you can educate yourself. I recommend a book called Common Sense Investing by John Bogle. A little bit biased, John Bogle is the creator of Vanguard funds. He preaches no management fees because those could eat into your returns. But if it works out for you, just get one. It's better than making no money. The author throws us a curveball here. He also suggests another investment option. He suggests annuities. Annuity is a contract between you and an insurance company whereby you pay a premium in exchange for a variety of guaranteed payout options for a set period of time or for the remainder of your life. Annuities are essentially insurance contracts, and the guarantee to give you is only as good as the company itself. There's 2 types of annuities. Let's go through the first one. First one's a fixed index annuity. They're more popular than their variable counterpart, which we'll go through later, and the money grows tax deferred here. So far, tax deferred sounds good. Guaranteed fixed rate of return, typically more than a CD. That sounds good as well. You don't participate in the full index gain, only a predetermined rate. For example, if an S&P index grows 20%, you only get a predetermined rate. Let's say it's 10%. You only get 10%. So you're missing out on the additional 10%. However, you never participate in the decline of the rate ever. That sounds amazing, actually. Your minimum gain is a guaranteed fixed rate. If the market plummets and the S&P loses 30%, you'll still make money. You're going to have the minimum gain, whether it be 3 or 5%, whatever it is. You're never going to lose money on an annuity. That sounds pretty good. And number 2 is a variable annuity. Tax deferred growth and a full index return. If the S&P grows 20%, you get 20%. However, there's no guaranteed fixed rate. If the S&P loses 30%, you'll lose 30%. I think the only advantage here is the tax deferral. Here are some annuity downsides. Number 1, tax as ordinary income when distributed. Number 2 is not liquid until you're 59 and a half. You can take it out though with a penalty of 10%. Just remember when you do take it out, not only will you have the penalty 10%, you'll also have taxes as well. Number 3, there's a lot of fees in these types of policies. Number 4 is only as good as insurance company covering it. So if the company goes bankrupt. And number 5, if you take a distribution before your agreed upon term, this is called a surrender fee and it charges 7 to 10%. You'll most likely get penalized on top of that, and also you get taxes as well. Okay, everyone, hopefully you're still awake. That was a lot of information. The author always does this. He tricks us with dreams and goals and then slaps investment vehicles into your face. But you know what? No harm, no foul. I think it's really helpful. Now I know what options I have to invest. You don't have to do this all at once. If you look at Nita's goals, her swimming goal, her instrument goal, and learning Chinese goal doesn't need any investment vehicles. She only needs to put it into a money market savings account. Only does her dream of a vacation home or a convertible car will take additional steps to invest. If you're curious about picking mutual funds, annuities, and index funds, I'll definitely do a video on those later on. And that is why you want to subscribe. I'll be posting a lot more tips in the future. And please, 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 if you haven't done so already, please like and share these videos with your friends and family. Be sure to check out the other videos on my channel. I hope everyone has a great week. Please apply these steps. Check us out next week for step number 8. Peace.